Plan 5 borrowers need to be ready. The 2026 repayment threshold could push many taxpayers into higher deductions.
What if I told you that from 2026, a huge number of UK graduates are about to face an effective tax rate of nearly 40% on every single extra pound they earn? It sounds pretty shocking, doesn't it? Well, it's the new reality. Today, we're going to walk you through exactly what's happening, using this fantastic guide developed by the expert tax advisors at My Tax Accountant.
And there it is, 37%. For many new graduates, this is the slice of money that will vanish from every pay rise, every bonus, or any bit of overtime they do. It's a massive figure. So over the next few minutes, we are going to unpack exactly how we get to that number and, most importantly, what you can actually do about it.
So here's our plan for today. We'll start by looking at this new financial reality. Then we'll compare the new Plan 5 loan system to the old one to really see what's changed. After that, we'll uncover some hidden income traps that are going to catch a lot of people out. Then we get to the good stuff, a really smart pension strategy, a crucial guide for employers, and finally, a clear and simple action plan for you to take away.
Right, let's get straight into it. How do we actually land on that startling 37% figure? Well, it's simpler and, frankly, a bit more worrying than you might think.
Okay, take a look at this. If you're a basic rate taxpayer on a new Plan 5 loan, every time you earn an extra pound, 20p immediately disappears for income tax. Then, another 8p goes to national insurance. And on top of all that, a further 9p is taken for your student loan. So, just like that, 37p of your hard-earned pound is gone before it even has a chance to hit your bank account. So what's behind all this? It's the new Plan 5 system. And you need to listen up if you're in England and you started your university course on or after August 1st, 2023. This applies to you, and believe me, it is a completely different beast to what came before. Now this slide is really interesting because it highlights three huge changes. First, the repayment threshold, that's the salary you have to earn before you start paying anything back, is now much lower, down at just £25,000. Second, the loan isn't written off for 40 years. That's a full decade longer than before. And third, the interest rate is a bit simpler. When you put all that together, it means many more graduates will be paying back more of their loan for a much longer time. And let's be clear, this is no accident. It is a deliberate policy shift. As financial experts like Martin Lewis have pointed out, the government's own numbers show this is all designed to move a much bigger slice of the cost of higher education away from the state and directly onto the shoulders of the individual graduate.
Okay, you'll really want to pay close attention to this next part, because this is where so many people get caught out. What HMRC considers income for your student loan is much broader than you might imagine, and it's absolutely crucial you understand this.
You see, we're not just talking about your salary here. The system also looks very closely at what's called unearned income. Now that's stuff like interest you get from your savings, dividends from shares, or rent from a property. But here's the real kicker. The personal savings allowance that protects some of your interest from income tax, well, it doesn't apply to student loans. And that creates a really nasty financial tripwire.
Right. Let's make this simple. Imagine a recent graduate, and they're earning $24,000. That's below the threshold, so that's fine. They also have exactly $2,000 in savings interest for the year. Now, because this unearned income is $2,000 or less, it's completely ignored by the system. The result? They pay nothing towards their student loan. But watch what happens next.
If that same person earns just £1 more in interest, tipping them over the edge to £2,001, they fall off a financial cliff. The system doesn't just look at that extra pound. Oh no, it now adds the entire £2,001 to their salary for the calculation. That tiny £1 change creates a sudden repayment bill of over £90. This is the part you'll want to remember. It's a trap so many people are going to fall into.
So, the crucial point here is that your whole financial picture matters. It's your salary, of course, any bonuses, profits if you're self-employed, rental income, and even benefits from your job that are on your payroll, like private medical insurance. All of it gets thrown into the pot when they work out what you owe.
Okay, so we understand the challenges. The good news is, you are not powerless here. Let's look at a really powerful strategy that can help you take back a bit of control over that 37% rate. And this slide illustrates the most effective tool in your financial toolbox, your pension. Specifically, a pension scheme that uses something called salary sacrifice. With this method, your pension contribution is taken from your gross pay before any tax or student loan is calculated.
This legally reduces your official salary, which then directly lowers the income figure HMRC uses for its calculation, and bingo, it cuts your student loan payment.
So here's my tip for you. A great way to think about it is that using salary sacrifice is like giving yourself a 9% bonus on your pension contributions. For every £100 you put into your pension this way, you're not just getting the usual tax and national insurance savings, you're also saving £9 in student loan payments you would have otherwise had to make. It is an incredibly efficient way to save for your future.
Now, we've talked a lot about individuals, but what if you're the one running the payroll? Stay with me for this next part because it's absolutely essential for every single UK business owner, HR manager, and payroll professional out there. These changes are going to affect you directly. The timeline on this is really tight. Come March 2026, HMRC will start sending out the official SL1 start notices for Plan 5. And then by April 6th, your payroll systems have to be updated and completely ready to make the correct deductions. Being ready from day one is absolutely key to staying compliant.
So what do you need to do? Well, it boils down to 3 key things. First, talk to your payroll software provider now to make sure they're ready for Plan 5. Second, when those SL1 notices land in your inbox, you have to act on them immediately. And third, you need to know how to handle multiple loans. Now, here's where some people get confused, but it's actually simple. You can deduct a postgraduate loan at the same time as an undergraduate one. Just a quick but really vital point on security. Any big financial change like this always brings the scammers out of the woodwork. It's a sad fact of life, but fraudsters will often pretend to be from the Student Loans Company or HMRC. So please advise your employees, and remember for yourself, that these organizations will never, ever call or email you out of the blue to ask for your passwords or full payment details.
Right, we have covered a lot of ground today, so let's make this simple and pull together the most important action points from this guide that you really need to take away. Okay, for individuals, the mission is clear. Get your head around that 37% rate, be incredibly careful with that £2,000 cliff edge on any other income, and find out immediately if your employer offers a salary sacrifice pension. For businesses, your absolute priority is getting those payroll systems compliant and ready for April 6, 2026. And for absolutely everyone, stay on your guard for scams.
Now, before we finish, it's really important for me to state that this guide is for general information. The world of tax and student finance is incredibly complex, and of course, everyone's situation is different. So this can't possibly replace tailored professional advice for your specific circumstances. To navigate these complex changes with real confidence, you really should speak to the experts. You can contact the team at My Tax Accountant directly by phone on 0208 570 8531, or you can send an email to info@mytaxaccountant.co.uk. And for more essential guides just like this one, please make sure you subscribe to the My Tax Accountant YouTube channel. Thank you so much for joining me.